Welcome, everyone. I'm excited to kick off our presentation on macroeconomics fundamentals. Today, we'll explore understanding the economy, focusing on key concepts like GDP and the circular flow. Over the next few slides, we'll break down these ideas in a clear and engaging way. So let's get started and dive into how the economy really works. Let's start by exploring how money moves through an economy. When we talk about the economy, growing by 3%, what does that really mean? Well, this presentation will help us understand the foundational concepts of macroeconomics. We'll look at the circular flow of income and expenditures, which shows how money circulates between households and businesses. We'll also examine the components of GDP, or gross domestic product, which is a key measure of economic activity. Lastly, we'll highlight the important difference between real and nominal GDP, so we can better interpret economic growth. Understanding these ideas will give us a clearer picture of how economies function and grow over time. Today, we're looking at the circular flow of income and expenditures, which is essentially how money moves within the economy. Think of it as the economy in motion, with money constantly circulating between different sectors. On one side, households provide factors of production like labor to businesses, and in return, they receive income. Then, households use that income to purchase goods and services from businesses, which generates revenue for those businesses. This cycle keeps going, creating a continuous flow. This concept is crucial because it shows us the interconnectedness of different economic agents and how their activities sustain the overall economy. Understanding this flow helps us grasp how economic activity is generated and maintained, which ties into the broader themes of economic stability and growth that we'll explore further in this presentation. Every economy, no matter how complex it may seem, is fundamentally built on a very simple truth. That truth is that one person's spending is actually another person's income. It might sound straightforward, but it's a powerful idea that underpins how everything works. Now, to help us understand this better, we use something called the circular flow model. This model captures this elegant interdependence between different parts of the economy. It shows us how money, goods, and resources don't just stay in one place. They keep moving, cycling through different sectors. This continuous flow is what keeps the economy running smoothly. It highlights how all these elements are interconnected and how every transaction has a ripple effect. Recognizing this simple truth helps us see the bigger picture of economic activity and why understanding this cycle is so crucial for analyzing economic health and growth. Now let's walk through how this simple economy functions. Firms use various resources, like labor, land, and capital, to produce the goods and services that households want to buy. Think of it as a continuous cycle. Households supply these resources to firms, and in return, they receive income, wages, rent, and profits. This income then gets spent on goods and services produced by the firms, which keeps the whole system moving. It's important to understand that money flows in the opposite direction to the real resources. When households spend their income, that money goes back to the firms. Meanwhile, wages and other payments flow from firms to households as compensation for providing their resources. This creates a simple but powerful loop. Households own and supply the resources, and they use their income to purchase goods and services from firms. This interconnected flow of resources and money is the foundation of our economy, highlighting how households and firms depend on each other to keep everything running smoothly. Now, let's take a closer look at the final goods and services delivered in the economy. Essentially, firms produce goods and services that are then delivered to households. This is the point where consumer spending comes into play, as households purchase these goods and services for their own use. In return, households provide firms with factor payments such as wages, rent, and profits. These are the earnings that households receive in exchange for their labor, land, or capital. These are the inputs that firms need to produce goods and services. Firms, on the other hand, supply households with the necessary factor inputs, labor, land, and capital, that are essential for production. This creates a continuous flow of resources from households back to firms. When we look at all these exchanges together, the flow of goods and services, income, and factors of production. They form what we call the four flows. This slide gives us a quick overview of how interconnected and dynamic these flows are within the economy, reinforcing the overall theme that economic activity is a continuous, circular process. Money flows one way, goods and services flow the other, two streams, one unbroken loop. This slide highlights a fundamental concept in economics, the continuous interaction between different sectors of the economy. On one side, we have money, which moves through households and businesses, fueling economic activity. On the other side, we have goods and services, which flow from producers to consumers. These two streams are interconnected. They form a cycle that keeps the economy moving smoothly. Think of it as a loop. Money circulates to buy goods and services, and in return, goods and services fulfill needs, which then generate more income. This cycle is essential because it illustrates how the flow of money and goods sustains economic health. Understanding this flow helps us see how different parts of the economy depend on each other. It's all interconnected. This concept ties into the overall theme of economic activity and how markets function dynamically. Let's take a closer look at this simple two-sector model. At its core, it shows how households and firms are constantly exchanging goods, services, and resources. The outer loop, which we've highlighted in orange or rust, represents the flow of real things, like products, services, and productive resources, moving between households and firms. Think of it as the tangible side of the economy. Inside that, there's a second loop, also highlighted, that depicts the flow of money. This is the income households earn and the expenditures they make when buying goods and services, and it moves in tandem with the real flow. What's important here is that, even though this model is simplified, it captures the essential logic of all market economies, the continuous interaction between the real economy and the monetary flow. These two loops are interconnected and keep the economy moving. This concept is fundamental as we explore broader economic dynamics and policies. The real world, of course, is more complex than our basic model. In addition to households and firms, there are three other key sectors that play a crucial role by injecting and withdrawing funds from the economy. These sectors help create a more realistic and nuanced picture of economic activity. We're talking about the government, the foreign sector, and the financial sector. Each of these adds layers of interaction that influence how money flows through the economy. The government, for example, collects taxes and spends on public services, which can stimulate or slow down economic activity. The foreign sector involves exports and imports, goods and services traded across borders, that also affect the flow of funds. And then there's the financial sector, which includes banks and other financial institutions. They facilitate savings, loans, and investments, helping to allocate resources efficiently. By expanding our flow to include these sectors, we gain a much richer and more realistic understanding of how the economy actually operates. It shows that the basic household firm loop is just part of a bigger, more interconnected system. Now, let's take a look at how different sectors interact within the economy. Households, for example, save a portion of their income, which we call a leakage from spending. These savings don't just sit idly. They're channeled by banks and financial markets into business investments, which are considered injections. Essentially, this sector helps transform those idle savings into productive capital that can be used to grow businesses. Moving on to the financial sector, exports are an important part of the picture because they represent injections. When foreign buyers purchase domestic goods and services, they bring money into our economy. On the flip side, imports are leakages, meaning when domestic consumers buy goods from abroad, money flows out of our economy. The difference between exports and imports is what we call net exports, and it plays a crucial role in our overall economic balance. Then there's the foreign sector, which manages taxes and government spending. Taxes collected from households and firms are leakages, money that leaves private hands. But this money is then recirculated through public spending on goods, services, and transfer payments, which are injections back into the economy. This process helps stabilize the economy, especially during downturns. Finally, the government sector acts as a key stabilizer. It collects taxes and then spends on various programs and services, helping to smooth out economic fluctuations. Overall, these sectors, households, financial, foreign, and government, are all interconnected, working together to sustain and stabilize the economy. Now, when we include all 5 sectors, households, firms, government, foreign, and financial, the circular flow really transforms into a complex web of interdependencies. Each sector interacts with the others, creating a dynamic system. Injections, which include investment, government spending, and exports, are the ways money gets added into this flow. On the other hand, leakages, such as saving, taxes, and imports, are the ways money leaves the system. It's important to understand that in a stable economy, these two forces, total injections and total leakages, are balanced. When they are equal, the economy remains in equilibrium, with income and spending levels stable over time. This balance is crucial for maintaining overall economic health. So, this 5-sector model gives us a more complete picture of how an economy functions, highlighting the interconnectedness and the importance of balancing these flows to sustain stability. Now let's look at the relationship between injections and leakages and how they work together to maintain a stable economy. On this slide, you can see that injections, which include investment, government spending, and exports, add money into the economy. Meanwhile, leakages, like savings, taxes, and imports, take money out of the economy. When these two are balanced, the economy reaches what's called an equilibrium. That means the total injections equal the total leakages, leading to a stable economic environment. Think of it like a continuous flow. If injections increase, leakages need to increase as well to keep things steady. Conversely, if leakages rise, injections must also rise to prevent the economy from slowing down. This balance is crucial because it helps us understand how different components of the economy interact and how policymakers can influence economic stability by adjusting either side. So, in essence, injections and leakages are two sides of the same coin, working together to keep the economy on an even keel. So, what is GDP? Well, GDP stands for Gross Domestic Product, and it's essentially a way to measure the total value of all the goods and services produced within a country over a specific period of time. It's a key indicator that helps us understand the economic activity happening within a nation. When we talk about measuring economic activity, we're looking at how active a country's economy is, whether it's growing or contracting. GDP gives us a snapshot of that activity by summing up everything produced, from the cars manufactured to the services provided like healthcare or education. It's a crucial figure because it helps policymakers, investors, and businesses make informed decisions. Throughout this presentation, you'll see how GDP plays a central role in understanding economic health. It's not just about numbers. It's about understanding the overall economic well-being of a country and its ability to provide for its people. To understand how well an economy is performing, economists need a single, comprehensive measure. That measure is Gross Domestic Product, or GDP. Think of GDP as the economy's ultimate scorecard. It summarizes the total value of all goods and services produced within a country over a specific period. Why does GDP matter? Well, it gives us a clear snapshot of economic activity and helps us compare economic health over time or between different countries. By looking at GDP, policymakers and investors can make informed decisions. It's a key tool that connects to the overall theme of economic performance and stability. So, understanding GDP is essential for grasping the bigger picture of how economies grow, fluctuate, and recover. GDP is the total market value of all final goods and services produced within a country's borders during a specific time period. Usually, we look at either 1 quarter or 1 year to get a clear snapshot of economic activity. Think of GDP as the overall scorecard for the economy. It's a way to measure how well a country is doing economically. By summing up all the finished products and services, we get a sense of the size and health of the economy. This helps policymakers, businesses, and individuals understand economic growth or contraction over time. So, in essence, GDP is a key indicator that reflects the economic performance of a nation at a given point. All three approaches to measuring GDP, total production, total income, and total spending, all lead to the same result. That's a key point because it shows how interconnected these different perspectives are. Total production refers to everything produced in the economy, while total income is the income earned by all the factors involved in that production. And total spending is how much people and businesses are actually spending on final goods and services. By definition, GDP can be measured in three equivalent ways. First, the core accounting identity emphasizes that these methods are just different sides of the same coin. Second, we focus only on final goods. This is important to avoid double-counting intermediate inputs, like steel used in car manufacturing. Third, GDP counts output produced within borders, regardless of who owns the firm. So, foreign companies producing domestically are included, but a domestic company's output abroad isn't. Fourth, it uses market value, meaning it sums everything based on prices to give a single, comparable number. And finally, GDP is measured over a specific time period, typically quarterly or annually. This helps us track the economy's performance over time. Understanding what GDP captures and how it's measured is crucial because it's the main indicator we use to gauge economic health and growth. It provides a comprehensive snapshot of economic activity, connecting production, income, and expenditure in a way that helps us analyze the overall economy. Let's take a closer look at this fundamental equation for measuring GDP. GDP equals C plus I plus G plus X minus M. Essentially, this formula sums up all the spending on final goods and services within an economy. It's one of the most widely used methods because it provides a clear picture of economic activity through expenditure. The equation breaks down into four main components. C stands for consumer spending, I is investment by businesses, G represents government spending, and X minus M is net exports, which is the value of exports minus imports. This approach is often called the expenditures approach because it focuses on how money is spent. By adding up these categories, we get a comprehensive view of the total economic output. Connecting this to our overall theme, understanding this method helps us see how different sectors contribute to the economy and how consumer behavior, government policies, business investments, and international trade all play a role in economic health. Let's break down some key concepts about trade and GDP components. First, exports bring in foreign money, so when we sell goods and services abroad, money flows into the country. Imports, on the other hand, send money out because we're buying from other countries. If exports are greater than imports, we have a trade surplus, which is a positive sign for the economy. Conversely, if imports exceed exports, we have a trade deficit. The difference between exports and imports is called net exports, often written as X minus M. This figure is an important part of understanding a country's economic health. Moving on, we have government spending, which includes all federal, state, and local spending on goods and services. It's important to note that transfer payments like Social Security aren't included here. They're just transfers, not purchases of goods or services. Next, business investment, labeled as G, government purchases, involves spending on equipment, structures, and inventory. This also includes residential construction. These investments are vital because they help drive the country's future productive capacity, meaning they set the stage for economic growth down the line. Finally, household spending, or investment, makes up the largest part of GDP, about 70% in the U.S. This includes spending on durable goods, non-durable goods, and services. It's the main engine of economic activity because when households spend, it fuels production and employment. So, by understanding these four components, net exports, government purchases, investment, and consumption, we get a clearer picture of how the economy functions and how different sectors contribute to overall growth. Because every dollar spent becomes a dollar earned, GDP also equals the sum of all incomes generated in the economy during the same period. This is a key point because it highlights that production and income are two sides of the same coin. When goods and services are produced, income is created for those involved in the process. So, in a way, GDP isn't just about output. It also reflects the total income earned by individuals and businesses. This approach reminds us that production creates income, and that the two are always equal by definition. It's a fundamental concept in understanding how the economy functions, linking what we produce directly to what we earn. This is called the income approach, and it helps us see how we earn money from the goods and services we produce. By understanding this, we gain a clearer picture of the overall economic activity and the flow of income within the economy. It ties back to our overall theme, that production and income are interconnected and essential to measuring economic health. So here's a key insight to keep in mind. One person's spending is always another person's income. This is fundamental because it explains why GDP, income, and spending are actually the same thing. It's an accounting identity, not just a coincidence. When we talk about income, it includes what owners of land, property, and financial capital earn from lending or renting out these assets. These are what we call rent and interest. Rent and interest are essentially returns for providing assets or capital to others. Then we have returns earned by business owners and shareholders. These are the profits that come from supplying capital and taking on risk. They're often called corporate profits, and they're a major part of the income pie. And of course, the largest category in most economies is wages and salaries, the income earned by workers for their labor. It's what fuels consumer spending and drives economic activity. So, when we look at income categories, they all connect back to the core idea that income equals spending, illustrating the interconnectedness of the economy. It's a simple but powerful concept that helps us understand how all these pieces fit together. Let's take a closer look at the inflation factor and its impact on GDP measurements. When we talk about real versus nominal GDP, we're essentially distinguishing between two ways of measuring economic output. Nominal GDP is calculated using current prices, so it doesn't account for inflation. On the other hand, real GDP is adjusted for inflation, giving us a clearer picture of actual growth in goods and services produced. This distinction is crucial because inflation can make nominal GDP seem higher than it truly is in terms of actual economic activity. Understanding this difference helps us accurately assess whether an economy is genuinely growing, or if apparent growth is just due to rising prices. So, in the context of our presentation, recognizing the inflation factor ensures we're making meaningful comparisons over time and better evaluating economic health. GDP measured in dollars can go up for two very different reasons. First, it could be because the economy actually produced more goods and services. In other words, there's more real economic activity taking place. Second, it could be because prices simply got higher, which we call inflation. This means that even if the amount of goods and services stayed the same, their prices increased, making the total GDP in dollar terms look like it's rising. Understanding the difference between these two causes is really crucial. If we just look at the dollar figure without digging deeper, we might think the economy is doing better when, in fact, it might just be inflation pushing those numbers up. So, to truly gauge economic progress, we need to distinguish whether GDP growth is driven by increased production or by rising prices. This helps us get a clearer picture of the real health and growth of our economy. Let's take a closer look at why nominal GDP can sometimes be misleading. Imagine prices go up by 5%, but the actual amount of goods and services produced stays the same. In that case, nominal GDP would also increase by 5%. On the surface, it looks like the economy has grown, right? But in reality, it's just because prices rose, not because we're producing more. This is an important point, because when we compare nominal GDP figures across different years, those higher numbers might not really reflect a bigger or healthier economy. They could simply be a result of inflation. Now, let's talk about what nominal GDP actually measures. It evaluates the current output using current market prices. That is, the prices that were actually in effect during the period we're looking at. So, it captures both two key things: changes in how much we produce and changes in prices. Because of this, nominal GDP can sometimes give a skewed picture of economic growth if we're not careful. It's like looking at a face value, hence the term nominal, which can be useful, but also potentially misleading if we don't consider the underlying factors like inflation. That's why understanding what nominal GDP measures helps us interpret economic data more accurately in this overall context. So, what we're seeing here is that nominal GDP can increase both through higher production and inflation. This means that it can give a misleading picture of economic progress because it doesn't distinguish between actual growth in output and rising prices. Essentially, if prices go up, nominal GDP might look better even if the real quantity of goods and services hasn't changed much. That's why it's considered a poor measure of real economic progress over time. It captures the total value at current prices, but it doesn't account for inflation. Now, the key limitation here is that nominal GDP is just the sum of the current price times the quantity produced for all final goods and services in a given year. This means it's heavily influenced by price changes, which can distort our understanding of actual growth. When we look at the formula, it's straightforward. Nominal GDP equals the sum of the current price multiplied by the quantity for every final good and service. But remember, because it uses current prices, it can be affected by inflation, making it less reliable as a measure of real economic activity. So, in the context of our overall discussion, it's important to recognize these limitations and understand why economists often prefer measures like real GDP, which adjust for inflation to give a clearer picture of true economic progress. Real GDP solves the inflation problem inherent in nominal GDP by valuing output using constant prices from a specific base year. What this means is that by holding prices fixed at those base year levels, we can better see the true changes in the economy's output over time. Any increase or decrease in real GDP then reflects a genuine change in the quantity of goods and services produced, not just price fluctuations. This approach gives us a clearer, more accurate picture of economic growth. It helps us understand whether the economy is truly expanding or contracting, independent of inflation. So, in essence, real GDP provides the true picture of growth by stripping out the distortions caused by changing prices. Let's take a closer look at what real GDP growth really signals. Essentially, it tells us that an economy is truly producing more jobs, more goods, more services. And that's a key indicator of improving living standards because it reflects genuine economic progress. Now, why is real GDP so valuable? Well, it allows us to make valid comparisons between different years and even between countries. This is because it adjusts for price level changes, so we're not misled by inflation or deflation. It reveals the real expansion or contraction of the economy. When we compare across time, we evaluate all years at the same base year prices. This way, if quantities increase while prices stay fixed, the rise in real GDP genuinely indicates growth in the productive output of the economy. To do this effectively, we choose a base year. The prices from this year are used to value output in all other years. Interestingly, in the base year itself, real GDP equals nominal GDP because no adjustments are needed. Prices are already set. So, to sum up, understanding how real GDP works through these three steps helps us see the true health of an economy, free from distortions caused by changing prices. It's the most reliable way to gauge real economic growth over time. Let's take a closer look at nominal GDP, which is measured in trillions of dollars, and real GDP, also in trillions of dollars, but adjusted to 2012 dollars. It's important to understand the difference between these two because they tell us different stories about the economy. Nominal GDP reflects the current market prices, so it can be influenced by changes in price levels, like inflation. On the other hand, real GDP accounts for inflation, giving us a clearer picture of actual economic growth over time. Recognizing the difference between nominal and real GDP is crucial for accurate economic analysis, as it helps us distinguish between growth caused by increased production versus price increases. This understanding ties back to our overall theme of evaluating economic health more precisely. Let's take a closer look at this chart. Notice how the nominal GDP line climbs steeply over time. This sharp increase is partly due to inflation, which causes prices to rise across the board. Now, if we look at the real GDP line, adjusted for inflation and expressed in constant 2012 dollars, it shows a more modest and accurate picture of the economy's true growth. The key point here is the gap between these two lines. That gap represents the cumulative effect of rising prices, what we often call inflation, over the years. It's important because it reminds us that nominal GDP can sometimes be misleading if we're trying to understand actual economic growth. By comparing the two, we get a clearer picture. Real GDP tells us the real story of economic expansion, not just how much prices have inflated. This understanding helps us evaluate economic health more accurately and make better informed decisions. Let's break down the key points here. First, nominal GDP reflects current prices, which means it can go up just because prices are rising, even if there's no real increase in the amount of goods and services produced. That's why we use real GDP. It adjusts for those price changes, giving us a clearer picture of whether the economy is actually producing more over time. You can think of real GDP as the gold standard for measuring genuine growth. Now, whether we measure GDP through spending, like consumption, investment, government spending, and net exports, or through income, such as wages, profits, rent, and interest, both approaches capture the full scope of economic activity. They're just two sides of the same coin. Next, think of GDP as a scorecard for the economy. Money, goods, and resources are constantly flowing between households, firms, government, foreign sectors, and financial markets. Every time someone makes a purchase, it creates income for someone else. And every income earned then fuels further spending, keeping this cycle moving. Finally, this is all part of the circular flow of the economy. It's a continuous loop where resources and money circulate, maintaining economic activity. So, in summary, understanding these concepts helps us grasp the overall health and functioning of the economy at a glance. These three concepts, circular flow, GDP measurement, and real versus nominal adjustment, really form the foundation of macroeconomic analysis. Understanding them is crucial because they help us interpret how the economy functions as a whole. The circular flow model, for example, shows us how money and resources move between households and businesses, illustrating the interconnectedness of economic activity. When we talk about GDP measurement, we're learning how to quantify the economy's total output, giving us a snapshot of economic health. And distinguishing between real and nominal values is key to understanding whether changes in GDP are due to actual growth or just inflation adjustments. Mastering these concepts is like having a set of vital signs for the economy. Once you get them, you can read economic trends with confidence and make more informed decisions. They truly are the bedrock of macroeconomic understanding.